Hello everyone, welcome to another video of ACUK Online. I am Sir Abdullah YUSUFI and today I'll be going over A-Less level Business Studies paper 2 and this is the paper from October-November 2021 session. I'll go over the data and then I'll go over the questions and give you a strategy on how to solve these questions. So let's begin the video.
Hello everyone. So now this is your business studies AS level. This is paper 2 data response and this is paper 9609 version 22 and this is October-November 2021. As you can see that you are given 1 hour 30 minutes to complete this paper and you will be getting 2 data response questions. So technically you can allocate 45 minutes each to complete one data response. Now make sure that if you're going more than this time, so you can try to keep this in mind that you need to complete one data response in 45 minutes, so in order to complete the paper in the given time period. Now first, before reading the data, it's good if you will just look at the questions so we know what we need to focus on while we're reading the data. So the first part is asking you to define the term fixed cost, and then you're asking you to define the profit margin. The part B1 is saying Ralph estimate the price elasticity of demand and to calculate the percentage change. So basically you will be calculating the percentage change in demand when the price is reduced by 10%. Explain one way in which Ralph could use price elasticity of demand when making pricing decisions. And then moving on, analyze one advantage and one disadvantage to Ralph of introducing job production. So we'll just focus on that. Recommend whether Ralph should use leasing or should sell his photograph printing machine as a source of finance for the equipment to make frames. Okay, so while doing this helps us identify the specific areas that we need to keep in mind when we're reading this data, because obviously there will be a lot of information over here that might not be so relevant with respect to the questions that are being asked. So starting off with data, they're saying SB is owned by Ralph, who is a sole trader. So that means that if he is a sole trader, though obviously he will have unlimited liability and there might be difficulties in raising finance. Moving on, the business prints photographs. Ralph has one shop on the main street of City D. Customers bring their saved digital photographs into the shop and these are printed on high quality paper. So basically he is just providing a service for printing photographs for people. SB uses a large printing machine that can print on almost any size of paper to produce different size photograph prints. The process is very capital intensive and most customers request a batch of photographs to be printed, right? So this is something that we know ourselves, that once you're getting your photos printed, you mostly have quite many of those, so obviously they will be producing it in a batch. As SB is the only shop in City D that prints photographs, so that can be a competitive advantage as there are no other physical print shops available. However, recently a number of online competitors have started to offer low price photographs prints to customers, so there is online competition, right? So this can be a challenge for the business. Ralph has noticed that his sales have decreased significantly because of this competition, and Ralph estimates the demand for his photograph prints has a price elasticity of demand of -4. So remember we had a question where we were asked to calculate percentage change in demand using the price elasticity of demand, so we will be using this over there. SB already has a low profit margin and Ralph is struggling to compete with the online retailers. However, Ralph has an idea to introduce job production into his shop. he could stop printing photographs and instead focus on framing individual photographs for customers. These frames will be made for any size photographs or picture and can be made from a variety of materials chosen by the customer. So again, this is something that one of the question was referring to. They asked us about whether changing into job production, and there was something related to that. We'll just get back to those. Moving on, Ralph will need specialized equipment to allow him to make the frames. The equipment would cost $10,000. So the new equipment that he might need, that costs $10,000. He has identified two possible sources of finance for this equipment. Now these two possible sources of finance are, the first possible source of finance is to lease the equipment from the company that produces it, and the lease would be for 5 years at a fixed cost of $400 per month. Okay, so if this is a lease, now we know for a lease we have to pay a monthly amount every month, and most of the time the total amount that you're paying will be quite more as compared to what you would have paid for the outright amounts. Now remember, he actually requires 10,000 for that new equipment. So basically he requires only 10,000 for that new equipment, and if he is going for the leasing option, we can calculate the total amount that he will be paying. So this is like 400 per month at a fixed cost of 400 per month for 5 years. So the lease would be for 5 years at a fixed cost of 400 per month. Now if we simply calculate the total amount that he might be paying, so that means he is paying 400 for 12 months, and this will give us like a figure of 4800 every year, and he has to do this for 5 years, so that can add up to the amount of 24,000. So technically if he leases the equipment, so the equipment that costs 10,000, he will actually be paying 24,000 for that equipment. Moving on, they're saying the second possible source of finance is for Ralph to sell the photograph printing machine for at least 10,000 to purchase the equipment to make frames. Now this over here can also be a source of finance that can be used, that he sells his existing equipment, and because he won't be using that anymore as he is now moving on into the framing business, so he can sell it for 10,000, and that 10,000 can easily cover the cost that is that he needs to pay to buy the new equipment. So this is all the information that is given to us in the data. Now quickly we'll just go over the questions. The first question was asking, define the term fixed cost. As we all know that fixed cost is the cost that remains unchanged with the level of output. So we can say that fixed cost is the cost that will not vary when the business increases its level of output, or fixed cost is the cost that remains the same no matter whatever the level of production. Part 2 is asking, explain the term profit margin. So profit margin is simply how much profit you're making from the selling price that you're charging. So we can explain the profit as the difference between the total revenue and the total cost, and profit margin is the difference between the revenue and the cost minus, as it is expressed as a proportion of revenue divided by the revenue. So basically this is your profit as compared to the sales that you are making. So remember, we used to have that formula for profit margin, so you can simply note that down, that profit margin is profit over sales into 100%, and profit margin will be an indicator how much profit you're charging from the selling price that you have. Moving on to part B1, use Ralph estimate of the price elasticity of demand to calculate the percentage change in demand for printed photographs if the price is reduced by 10%. Now above, when we were reading the data, we had this information over here that mentioned that the demand price elasticity of demand is -4, and over here they have given you that the price is being reduced by 10%. So in this question they have already given you the value for PED. right? So we do know that the formula for PED is simply percentage change in quantity demanded over percentage change in price. So in the question they have given us the value of PED as negative 4, and we have to calculate the change in quantity demanded, and the change in price has been given as negative 10%. So if we simply solve it further, we know that this will be 10 multiplied by minus 4, that will give us 40, and minus minus sign is cancelling out, so this is like 40%. So we can say that the percentage change in quantity demand is 40%. Now looking back at the question is asking calculate the percentage change in demand. So we'll just stop over here. So the percentage change in quantity demand is 40%, and this is actually a 40% increase in the demand. Why? Because we are having a positive value. So we can simply say that when the price is reduced by 10%, the quantity demand for SB's photographs, printed photographs, is going to increase by 40%. Alright, so now moving on to the next part, which is explain one way in which Ralph could use price elasticity of demand when making pricing decisions. So when we are making pricing decisions, PED can be very helpful for a business, because you will know approximately how much increase or decrease in your price may result in any change in your revenue. So this is used to know whether we can offer a discount in the price in order to promote our product, whether it will enable us to increase our sales or not. So the elasticity of 4 over here is quite greater than 1, and this indicates that this is a very price elastic product. So, and we can also see that when here is reducing the demand, when he is reducing the price, that is actually causing the demand to increase. So if Ralph decreases the price of photograph printing by 10%, he may gain an increase in sales of 40%, which means that he will be making more profit. So you can simply write these points in the answer for this part too. Okay guys, so moving on to part C, this is saying analyze one advantage and one disadvantage to Ralph of introducing a job production. Now in the data they did mention that he is currently doing it in batches, and now if he wishes to convert to job production, so we just have to mention the advantage and one disadvantage. Now we can simply say that one advantage of using job production is that he may be making a unique product, and as a result he can also charge a higher price for that. So because he will be making a specific customer specific photo frames which will be fitting different sizes, different shapes, and so therefore he can charge a different price to every customer. And we can also say that his product will be of a better quality, because these will be specifically focused products. They are made to order, and this means he can also have a high profit margin if he is charging a higher price because of that. And this can lead to more profit for Ralph, as he will be having this unique selling point over its competitors, because remember it was mentioned over there that now there are more online competitors available which are offering low price photograph prints. So definitely now he will be able to develop a particular niche for his product where he can charge a higher price, and this USP will give him a competitive edge over his competitors. Another disadvantage that we can talk about is that the high cost of production may lead to frames being too expensive, and this can be a cause for increased cost of production, and this can reduce the profit margins. So we can also say that the new equipment that is required can put in an additional capital cost, because obviously he will have to arrange for a source of finance. This is what was mentioned over here in the case, that he needs that new equipment to implement this new plan of his if he wants to enter into the framing business. Now so if Ralph is going for the new equipment, he will have to pay the additional capital cost, and if he sells his old one to fund the cost of purchase of the new equipment, that will also mean that he might be leaving his current business, he might be leaving his current customers or current market share, and that may reduce sales revenue or the variety of services that he is offering. So this is the one advantage and one disadvantage that you can give in detail. You should try to make sure that you can divide, because like this is for 8-mark questions, so you can focus on 4 marks for advantage and 4 marks for one disadvantage. You need to connect this with your knowledge and application by using the information that has given to us in the question. So over here where we talk about how the cost will be increased and how that may be reducing his profit, this is the part where we're analyzing the answer. So now moving on to part D, which is recommend whether Ralph should use leasing or should sell his photograph printing machine as a source of finance for the equipment to make frames. Justify your recommendation. Now before I answer this part, I'll move back to the data, and remember, while we were reading this, I did do this small calculation over here where it was identified that he will be paying a fixed cost of 400 per month in order to obtain this equipment on leasing. So technically, if this was 400 per month, he is paying 12 month every year. So 400 into 12 makes it $4,800, and that into 5 years will make it $24,000. So in order to obtain a machine that is worth only $10,000 if paid outright, he will actually be paying $24,000 for it. So looking at this in a single glance, we can simply say that leasing is definitely not the better option for him. So what we do over here is, like, this is a 11 marker question. We try to compare both the scenarios, both sources of finance, and we will also evaluate our answer based on the justifications that we can come up. So if we start off by comparing the two, we can start off by saying that leasing as a source of finance, well, leasing will involve paying a monthly fee, and this is done for a period of time. So instead of paying the amount outright, you're paying a small proportion of amount over a number of years. However, leasing will cost you a lot more. So in this case, we see that they have to pay a monthly installment of 400 for a period of 5 years. So that is adding up to a total of 24,000 at the end of 5 years. And this is definitely a greater cost to Ralph than if he sells his equipment, because if he technically sells his equipment for 10,000 and he needs the same amount of money to be purchased to purchase the new equipment that is of 10,000. So however, there is this extra 14,000 that he will be paying if he decides to go for the leasing option. Now we can simply evaluate this by saying that Ralph should choose to sell his printing machine, because obviously that will cost him less as compared to the leasing option. And however, at the same time, if he sells his existing machine, he will be letting go of the current customers that he has or the current market share that he holds, because that is specific to the printing part of his operations. Then again, if you're looking at it that the amount of money that he will be paying if he lease it out, that will definitely add up to a lot more than what he has to pay right away. So we can simply conclude this by saying that it is better if he go for the leasing option, and we will add in all the numbers and you give this calculation that he needs to that the calculation regarding the calculation that I did over here for the leasing part. So the total amount that he has to pay if he leases.
Okay, so we can conclude with our recommendation that we recommend him to sell his original machine and then purchase the new machine using the money that he obtains rather than leasing the equipment, because leasing will be more costly for him in terms of the money that he'll be spending over the number of years in future. So this is it for today. I hope you guys find this video useful. Please do leave your comments and do post any uh, questions that you have, and I'll try to answer those. Thank you. Okay guys, so hopefully this video was helpful to you. Please do leave your comments in the boxes below. I'll try to answer all your questions, and also do post any request for specific papers or part of the questions that you would like me to help you solve. Thank you. Thanks for watching.